Hampton Roads, and welcome to this week's edition of Beyond Wall Street, the show that helps take the mystery out of what's going on in Wall Street and make it make sense for you on your street. I'm your host, Kristen Oakley, and joining me in the studio, we have Kenny Porter. He is the president and founder of Kenneth Porter and Company, based right here in Hampton Roads. Kenny, my friend, it's great to be back with you. What's going on in your world this week?
So it's been an exciting time in our firm. We've had a lot of growth, which has been amazing. We had one of the episodes we were on, you got to meet Wes. So
yes.
A lot of great things happening at Kenneth Porter and Company.
It's exciting. I'm hoping we'll have him back for a future episode too.
Yeah, I'm sure we will. Thank you.
Well, great. Well, I know we have a very important subject to get into today. Did you know that your tax bill doesn't go away in retirement? You know, it's interesting. A lot of people think that they're going to be in a lower tax bracket in retirement, but for a lot of folks, that's proving not to be the case. And it is so important to know what your potential tax liability can be and to see how you can create greater tax efficiency throughout your full financial plan. Because at the end of the day, it's not about how much you have, it's about how much you get to keep. And Kenny, you know better than anyone how much taxes can really eat away into someone's retirement plan.
I see it day in and day out. So many people plan for retirement distribution phase that focuses on their portfolio and portfolio return.
Right. How much am I earning from the market,
That's
right?
exactly right.
Yep.
But I think what's most important for a consumer to think about, Kristen, is that what are they going to earn after tax? And when your calculations are being done with your advisor or with anyone in my firm, it's important to know your after-tax number and your effective tax rate.
Right.
Versus your marginal tax rate.
Yes. All right, so let's get into all of this. But to set up the context for today's discussion, I think it is important to help folks understand that there's a difference between tax preparation, which is what your CPA does for you, and engaging in strategic tax planning, which I know you're really passionate about doing for folks. So explain the difference between those two areas of tax work, if you will.
So we're not replacing your CPA or tax preparer. Those professionals do a specific job as it relates to tax compliance and as it relates to the preparation of the return.
Right, and we all need to do it. We need our CPAs,
That's right? Yeah, I have a CPA, I have an
Mm-hmm.
advisor that I've worked with from a tax point of view for 15 plus years. And that person has helped me in the preparation of the strategies that I've laid out for myself and even for my company. So the difference between the two is that many people will make their tax preparer, they turn them into a historian. Because what happens is that somewhere around December to February, they walk into their CPA or their accountant's office, the tax preparer, and they hand them the proverbial shoebox. And here's all my receipts, here's all my stuff.
Here's everything that happened last year, right? Yeah, right.
So they're looking in the rearview mirror to plan for what's coming. And we want to take the position of let's look forward. Let's do some forward forecasting and let's know in advance. Let's start in January preparing for what we're going to do in that entire year. Actually, let's start planning Q4 of the previous year.
Right.
And start planning for next year and how we should prepare for the coming tax storm.
Right.
Tax is one of those words. I like to say tax is a 3-letter word that makes people say 4-letter words.
Right.
And we don't want to see our clients get so angry and cussing and fussing over tax. Let's prepare for that consequence that we know is taking place.
Well, I know one of the reasons why engaging in strategic tax planning is so important is because the majority of Americans have the bulk of their wealth saved up in tax-deferred accounts.
That's right.
Share why that is becoming so problematic for so many people.
So tax-deferred accounts, we're talking about IRAs, 401ks, it could be SARSEPs, Simples, KEOs, you know, some of those old plans that were around years ago. In the 1970s, the tax code really changed to deal with defined contribution plans versus defined benefit plans. In the old days, a lot of our clients had pensions. And then pensions got replaced in the 1970s with defined contribution or 401k. And they were taught, based on previous tax history, that they were going to be in a lower tax bracket when they retired.
Yes, we were all told this was a good thing, right? It's a good thing to put as much money as you possibly can in a tax-deferred account because theoretically, in retirement, you'll be in a lower tax bracket.
And I'm here to tell you that that's not the case, that if you're in a situation where you've done a really good job of saving money and that you've done it on a consistent and ongoing basis over your working career, and you're moving now from that accumulation phase into your distribution phase, there's a high probability that you have the potential of paying more income tax in your retirement phase because, Kristen, income stacks. It's not just the W-2 anymore.
Right.
Now it's the RMDs, required minimum distributions.
Yep.
It's Social Security. It's capital gains on your taxable investments. And I'll share with you a personal story. My grandmother was a triple dipper. She was a wave in the U.S. Navy. Her husband retired from the Navy, and then they went into civil service.
Wow.
And so they were great patriots. But what ended up happening is that they had so much tax deferral, and they had pensions, and they had Social Security, that they were taxed at a higher rate in their distribution phase than they were in any of their accumulating years.
Isn't that amazing? Yeah.
And so that fact I've seen play out over and over and over again. And so we have to position ourselves in a way that we can minimize the greatest risk to wealth is income tax. And if your CPA or your preparer is telling you there's no way to reduce the tax, you're stuck, you should probably have a conversation with my firm, and we will talk with your CPA or your tax preparer and come up with tax plans to mitigate and minimize the cost of income tax in your distribution phase.
You know, you bring up a really good point, because I think what I hear a lot of folks say is, oh, I just have to pay tax. That's just the way that it is. And I think often with taxes, it's almost like people are playing a game that they've never been given the rule book to.
Yeah.
And a lot of folks forget that the tax code was originally written to help you pay the least amount of tax as possible. But instead, what's happening is people are unknowingly getting hit with greater tax liability when that can be proactively planned for and against to create greater tax efficiency.
So there's a saying that I have: if you want to change your tax, you have to change your facts.
I like
now,
that, Kenny.
facts have to be factual.
Right.
So we're not encouraging people to lie, by no means.
For sure not, yes.
Right? That is tax evasion. Tax evasion, everybody ends up in orange and spending a few years in
we do
no
not
way.
want that.
That's not what we're talking.
Right.
We're talking about tax avoidance. Avoiding a tax that you can legally reduce in your distribution phase is something that's in your best interest. That's something that you should look to do.
Right.
And not ask if you can, but ask how. So when you're talking to your tax advisors, how can I reduce my tax? There could be real estate strategies. There could be business strategies. Now, many people think when I go into retirement, the last thing I want to do is own a business. But the tax code is very favorable to business owners. And for the individual taxpayer, it can be very burdensome.
Right.
So we talk to our clients about, hey, what are you passionate about? What dreams or desires do you have? And is there a way for us to help you enter into a legitimate business in your distribution phase and do that in a way that it can also complement reducing your income tax when you're taking those distributions from things like your retirement accounts that have been pre-taxed.
Right, yeah. So many strategies go into this. I'm excited to get more into it. I know you have no shortage of stories to share about people you've been able to help in this area. But for our viewers who are watching today, if they're going, you know what, I've actually never had these kinds of conversations. I've maybe never even thought about the difference between tax preparation and tax planning. What would you say to someone who's really needing some help in this area? So
it's important to verify, Kristen. So we give them a process that helps them be able to verify where they are and where they're going to potentially be from a tax point of view. And we call it tax mapping. So it's kind of like if you're going to take a journey from Virginia Beach to San Diego, you would lay out a plan.
Right.
And there's software and there's tools for that. You know, like Waze is a great tool.
Yes, I'm a
to
huge
get you
Waze
from where,
fan.
Yeah, it'll tell you where the police are. It'll tell you where there's construction. Our tax mapping has a very similar structure to that as it relates to tax planning and tax strategy. So we like to offer our clients a no obligation tax map so that they can see where they are today and look at the strategies that we deploy that can help them see, should they take a distribution from the IRA, from the 401k, or should it come from a non-taxable account or an account that's post-tax.
Right.
And we can talk about that more later in the show, but that is a complimentary offer that we make to our clients to give them a no obligation tax map that they can take to their current advisor, or we can share with them strategies and how we would implement a tax efficient plan for retirement.
Wonderful. Well, Kenny, I'm excited for more folks to get to connect with you. So if you would like to take advantage of this offer and receive your very own complimentary tax map from Kenny and the team of Kenneth Porter and Company, it's really simple. All you need to do is just call that number on the bottom of your screen, 844-575-8071. You're also welcome to take out your smartphone, and if you open up that camera app and point and click and scan that QR code down in the bottom right-hand corner of your screen, that will take you over to a landing page, ask you a few short simple questions, and then a member of the team will reach out to connect with you to schedule a time for you to come in and receive your very own complimentary tax map based on your individual situation. More on today's episode of Beyond Wall Street right after this.
So our philosophy is to really help the client understand how to navigate from a position of where they are to where they really want to be. Most financial planning, I think, focuses on the needs aspect. We like to approach financial planning from the point of view of wants planning. What do you want from your retirement? And if we can work towards wants goals versus needs goals, we believe you're going to be much happier and much more successful in your distribution phase by focusing on the want versus the need. We pride ourselves on giving our clients our personal cell numbers and being able to be on speed dial if they need me. They know they can get me personally still. They also know that they have the confidence in my team because they've been so well trained, a team of certified financial professionals and financial analysts that can help our clients with planning strategies. So our clients typically are coming to us in that pre-retirement or retirement phase. So they've already either done a good job with their current advisor through the accumulation phase, or a lot of our clients started out as do-it-yourselfers. And they knew that getting to the distribution phase, that there's far more complex issues to deal with. And so they want to come to an expert to get help with how do you take distributions appropriately. I would say that most of our clients are coming to us out of a need and a desire to try to improve their retirement distribution phase.
Welcome back to Beyond Wall Street. I'm your host, Kristen Oakley, here with Kenny Porter, who is the president and founder of Kenneth Porter and Company. We are talking today about creating greater tax efficiency as part of your retirement plan. And it is so important to know every tax bill you're going to incur for all the different type of money that you're going to be entering retirement with. And Kenny, you touched on this, but I think it's really important just to kind of simplify this for folks from the get-go and helping people understand the different types of money and their tax treatment, because most people tend to enter retirement with three types of accounts. You have taxable accounts, tax-deferred accounts, and tax-free accounts.
That's right.
So why don't you go ahead and define, just so everyone can be on the same page, what those different accounts, what qualifies for those different kinds of accounts, and what we need to be paying attention to with them.
So I think it's appropriate to start with probably the most popular account is tax deferral. That's what you hear the most conversations around the water cooler to the financial advisors. Let's focus on a pre-tax account. Pre-tax being tax deferred, you might hear it that way. So a pre-tax account would be a 401k, an IRA, or any other qualified plan as it's been appropriated by the Internal Revenue Service.
Right, and I always think a qualified plan, that's what it means you're qualified to pay tax on it, right?
That's right.
And
you're qualified to pay tax on it at a rate that the government gets to decide at a future date.
Right.
So I like to call pre-tax or tax deferral, that's a sexy word for tax postponement. So if I was going to postpone something like the pain, if I'm going to defer the pain, but I know it's coming, most people would say, you know what, let's just get it out of the way today.
Right.
But there's an efficient way to do that. And sometimes those efficient ways don't seem like it's not very reasonable. I'll give you an example. Some people will take a post-tax account like a Roth IRA, and they'll go, well, Kenny, if taxes in the future are going up, then I should just convert everything to a Roth. That's a great thought, but it could be inefficient if you do too much too soon.
Right.
So that's where tax mapping, and we use tax mapping to help our clients be able to see the cause and effect before they do it.
Right.
So they don't go to the CPA as the historian and go, hey, this is what I did, what's my tax bill?
Right.
We want to look at the tax bill before it actually happens. So that's dealing with pre-tax, post-tax being Roth IRA, Roth 401ks, even permanent life insurance can fall into that category, sometimes called tax preferred. What that means is that we're going to pay tax on an asset today, and then we're going to get the growth on that account tax-free, and we're going to get the distribution tax-free. That's powerful.
Yeah.
Everyone wants to be in that position, but we've been taught in our early years, from the 1970s to where we are today, that we live in this pre-tax world because the mindset was that we would be in a lower tax bracket. The reality is that's not really happening, so we have to strategize how to mitigate and minimize income tax, not all at once, but over your entire retirement.
Right.
And then there's the taxable account. The taxable account would be those dollars that you've already paid taxes on. It could be setting in a CD, a money market, a stock or brokerage account. But where that money sits and how it's titled has more to do with the taxation and its future taxation. Those taxable accounts are going to have capital gains versus being taxed at ordinary income.
Right, which usually is more favorable depending on the situation, right?
That's right.
Yeah.
Yeah, ordinary income tax can range from 10% up to 37% under our current rules. Now, there's a little catch there. There's a sunset provision that's coming around December 31st of 2025, which is going to take the Tax Cuts and Jobs Act that President Trump's administration put in force.
Yeah.
And that's a temporary tax. So it's going to take the power of Congress to legislate changing that rule to make it permanent. Otherwise, most Americans are going to see about a 3.5% increase in their taxes come 2025.
So translation, basically, if Congress does nothing, taxes are set to go up starting in 2026.
That's
and that's why this is really important. A lot of people are saying taxes are on sale right now.
Yeah.
So that's why these strategies are even more critical and time sensitive. But to your point, so many people, the majority of Americans, have the bulk of their wealth saved up in these tax-deferred accounts. Now, maybe for you that is a 401k. It could also be any other type of workplace retirement plan. Maybe you have a 403b, a 457, a TSP. But also you work with a lot of business owners who have been able to save up money in other types of plans that are also tax deferred. So, what are some of the things that folks who have the majority of their wealth in those accounts really need to be planning for now?
Yeah, it's a great question, and so it really depends, right, is the overarching answer.
Like so much in the area of personal finance, right?
Right. That's the whole thing. It's not one size fits all. That's why you need customization.
Yes.
With an individual specific plan that deals with your focus, your wants, your needs, your desires. And whether it's tax mapping or it's doing an overall holistic financial planning strategy, it needs to take your situation into consideration and drown out all the noise with what everyone else is doing.
Right.
What matters for you and your family. And today in the accumulation, the distribution, and then into the legacy phase. Tax is your greatest eroding factor in wealth. It could represent anywhere between, 10 to 37% of your wealth going out the door just for income tax. Not to mention state or inheritance tax or estate tax.
On top of that. Yeah, and it's interesting that you said it's the greatest eroder of wealth because I think more people are familiar with inflation, which we often refer to as the stealth tax. But talk about why this tax risk, if you will, poses an even greater threat.
Yeah, it's a great question, and the thought is that there's a high potential that income taxes go up in the future. And it's simply because we have significant national deficits. Our admitted debt today is about $33 trillion. There's an economist named Dr. Lawrence Kotlikoff who actually believes that debt in fiscal GAAP accounting could be over $133 trillion with a T. And so that means that each of us as taxpayers are facing a future generational coming storm of income tax that's got to be paid. The debts of our nation have to be paid back. And so it's not that we're trying to say you're not going to pay an income tax. What we're trying to say to our clients is let's pay the least as legally possible.
Right.
And let's work as a team with your CPA, with your tax attorney, and any other professional to help you mitigate and minimize that risk in the future that's coming.
Well, when people do come in and meet with you for the first time, how many of these folks have actually engaged in any type of tax planning prior to meeting with you?
You would probably be alarmed to hear me say that very few, and I would say very few to the point of 99.99%.
I believe it, because you and I both know that a lot of the corporate firms don't engage in tax planning. They're not even allowed to have these kinds of conversations.
That's right. And there's a part of our firm where we do outsource CFO work for small companies, 0 to about 25 million in revenue. And we work with these business owners. And a lot of them have been veterans, and I have a heart for veterans, being a prior Marine.
Right.
And these veterans will come in where they've got a pension already. They have TSP, Thrift Savings Plan. And then they've done a good job of either becoming an independent contractor for another government vendor, or they've started their own company.
Right.
And you take that, mash it all together, and this person has a tax explosion. And so what we do is we step in as a CFO and we look at their business and their business plan. And that business plan needs to take into consideration reducing taxes on their future wealth and their future growth of their company.
Yeah. Well, so much goes into this. I know you're so passionate about it, and I know that you're looking forward to helping more folks engage in this tax saving strategy. So if you're at home and you would like to get a second opinion on your current situation as part of a complimentary portfolio review, Kenny and the team of Kenneth Porter and Company would love to provide you with your very own complimentary tax map. Now, again, this is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how they can help and serve you. So we encourage you, pick up the phone, call this number on the bottom of your screen, 844-575-8071, or you're also welcome to scan that QR code down in the bottom right-hand corner, and that will get you connected as well. More on today's episode right after this.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Welcome back to Beyond Wall Street. I'm Kristen Oakley here with Kenny Porter. He is with Kenneth Porter and Company, the president and founder based right here in Hampton Roads, and we are having a very important conversation today around creating greater tax efficiency as part of your overall plan, specifically in retirement, because the reality is a lot of folks aren't even aware of what their future tax bill might be in retirement, but this is what you are so passionate about doing, is helping folks pay the least amount of tax that they are legally required to pay. And I know that you work with a ton of small business owners in the Hampton Roads area, and that there are several tax saving strategies that you're able to employ for them. So I love stories. I love hearing more about the people that you work with and how you're able to help and serve them. So take it away.
Yeah, so there was one specific story with a client who onboarded with us last year. And this individual was a retired physician and had saved significant seven figures in his retirement plan. He still had a passion to work, but he wasn't sure what it was he wanted to do. So we went through an interview process with him. We looked at the tax map and tax mapping his situation out. It was very apparent that he was going to have a significant tax bill each and every year in his distribution phase because, one, he was approaching required minimum distribution. So he was already in his late 60s. We saw in this future planning that he was going to have distributions that were greater than his average income over his work history. So what we did is we found out what he was passionate about, and we found out that he had a few properties. And so real estate is one of these great assets that can be used to help reduce income tax because the tax code allows for what's called depreciation. So in his particular case, we found out that he was doing short-term rentals, and we were able to use another form of depreciation called cost segregation.
Okay.
And we were able to take 27.5-year depreciation schedules on residential real estate, and we were able to shrink that into 1, 3, 5, and 7-year buckets of depreciation.
Oh, wow.
So if you think about that from a tax point of view, that depreciation where he was getting 1/27th of a reduction, he was getting about a 30% deduction in year one on his real estate depreciation. So we were able to accelerate depreciation.
Right.
And there are strategies like that, Kristen, that can be used that if you're not having that conversation with your CPA, you're probably going to miss out on deductions. And we are a intermediary in some sense, where we step in and say, hey, Mr. and Mrs. CPA, this is the interview we had with our client, our joint client. And these are the things that they want to do in the retirement distribution phase. Here are strategies that we've recommended. What say ye? And then we have a literal meeting of the minds to where we are working in the client's best interest to reduce and minimize income tax, which effectively increases yield on their entire portfolio.
And what a beautiful thing to be able to just show people what the options are to help them be able to keep more of their hard-earned money. That's really critical.
That's right. And for an individual who's being told that they cannot reduce their income tax, that they are where they are, have a conversation with us. Get a second opinion. And as I like to say, you can never get a second opinion from the first person that gave it to you. So give us a shot with no obligation to have a conversation about how can we help reduce your income tax in the distribution phase. And if you find out that you like working with us on that level, then we can expose you to the other opportunities that we have with our firm, to working with Wesley Gomez in our investment advisory practice, to us bringing together the actuarial science on our insurance side. So it's a complete holistic view that we have of our clients and helping them move from where they are to where they want to be in the distribution phase.
Absolutely. So much goes into this, and I love your passion for it. I know this is what you do day in and day out for people. So Kenny, thank you so much for being here.
Thank you, Kristen.
And while this might be new to you, the good news is it's not new to Kenny and the team of Kenneth Porter and Company. They would love to help and serve you when it comes to creating greater tax efficiency or any aspect that you're needing help with as it relates to your financial planning needs. So we encourage you, pick up the phone, call that number on the bottom of your screen, 844-575-8071. We love you, Virginia Beach and Hampton Roads area. We look forward to being back with you next time.